Hey, welcome back. Here is something that might surprise you. The crypto investors who have built genuine, lasting wealth in this market are not the ones who made the biggest bets. They are not the ones who took the most risk. And they are definitely not the ones who stayed glued to charts 24 hours a day, managing every single price move with maximum stress and anxiety. They are the ones who mastered something that most people in this market completely overlook: their mindset, specifically how they think about risk, how they manage stress, and how they make decisions when the market is in chaos and everyone around them is either panicking or becoming irrationally overconfident. Today, I am going to break down exactly how the most successful crypto investors think and operate: the mental frameworks, the stress management practices, and the risk mindset that separates people who build lasting wealth from people who make money in bull markets and give it all back. Let us get into it. They think in probabilities, not certainties. The first and most fundamental mindset shift that separates successful crypto investors from everyone else is how they think about outcomes. Most retail investors think in terms of right and wrong. This trade is going to work. This project is going to go up. This call is correct. And when it does not work out, they experience it as a personal failure that triggers an emotional response. Successful investors think in probabilities. They never say this trade is going to work. They say this trade has a 60 to 70% probability of working based on my analysis, and I am sizing my position accordingly. If it does not work, that is within the expected range of outcomes. It is not a failure. It is part of the statistical reality of trading. This distinction sounds subtle, but it changes everything about how you experience loss. When you think in certainties and you are wrong, you feel stupid, you feel like you failed, and that emotional response pushes you toward revenge trading, toward doubling down, toward making emotional decisions to fix the psychological pain of being wrong. When you think in probabilities and a trade does not work, you feel nothing particularly dramatic. It was one of the expected losing trades in a series. You move on and take the next trade with the same measured approach. The practical application is simple. Before every trade, instead of asking yourself, am I right about this? Ask yourself, what is the probability this works based on my setup, and is my position size appropriate for that probability? This single reframe reduces stress dramatically because you are no longer betting on being right. You are executing a probabilistic process that works over time, even when individual trades do not. They separate process from outcome. The second mindset principle of successful crypto investors is that they judge themselves entirely on process rather than on outcome. This is one of the most counterintuitive ideas in all of trading, and it is one of the most powerful. Here is what it means in practice. A good trade is not a trade that made money. A good trade is a trade where you followed your rules perfectly, analyzed the situation correctly based on available information, sized the position appropriately, and executed the plan cleanly. Whether it made or lost money is partially outside your control. A bad trade is not a trade that lost money. A bad trade is a trade where you broke your rules, let emotions guide your decisions, sized the position recklessly, or entered without a clear plan. Whether it accidentally made money is irrelevant. Why does this mindset reduce stress so dramatically? Because the outcome of any individual trade is influenced by factors outside your control: news events, whale movements, macro shifts. You cannot control these, but you can control whether you followed your process correctly. When you judge yourself on process, you are measuring yourself against something you actually control. And that removes the enormous psychological weight of feeling like every market move is a verdict on your intelligence or skill. Crypto millionaires review their trades weekly not to count profit and loss, but to audit their process. Did I follow my criteria? Did I manage risk correctly? Did I stay within my rules? The profit takes care of itself when the process is consistently sound. They have non-negotiable risk limits. The third principle is the one most directly responsible for long-term financial survival in crypto. Successful investors have non-negotiable risk limits that they never cross, regardless of how confident they feel about an opportunity. They never risk more than 2% of their total portfolio on any single trade. They never put more than a predetermined percentage of their total net worth into crypto assets, regardless of how bullish the market looks. And they have a maximum drawdown threshold beyond which they stop investing and review their entire approach before deploying more capital. These limits are not flexible. They are not suggestions. They are absolute rules that hold even under the most extreme market conditions and the most compelling apparent opportunities. Here is why this matters so profoundly for stress management specifically. The number one source of devastating trading stress is positions that are too large relative to your overall financial situation. When you have too much on the line, every price movement becomes a source of anxiety. You cannot sleep, you check the price obsessively, you make emotional decisions because the stakes feel existential. When your position sizes are correctly calibrated to your risk limits, the market can move against you significantly without threatening your financial well-being. And when your financial well-being is not threatened, you can think clearly, you can be patient, you can make rational decisions. Right sizing positions is not just a risk management technique, it is a stress management technique. And the most successful investors understand that their ability to think clearly is their most valuable asset, worth protecting above all else. They protect their mental state as seriously as their capital. The fourth principle is one that most financial content never discusses, but that every genuinely successful long-term investor practices. They actively protect their mental and emotional state as a professional obligation. Here is what this looks like in practice. They have defined hours for market engagement. They are not checking prices at midnight or first thing in the morning before they are fully awake. They have boundaries around when the market has access to their attention and when it does not. They have physical practices that maintain their capacity for clear thinking, regular exercise, adequate sleep, time away from screens. These are not luxuries, they are professional requirements. A tired, sedentary, screen-addicted investor makes worse decisions than a rested, physically active one. The research on this is unambiguous. They maintain perspective through diversification of meaning. Trading and investing are part of their life, not the entirety of it. Relationships, health, creative pursuits, and other interests ensure that no single market event carries the psychological weight that comes from having your entire sense of well-being tied to a price chart. And critically, they have predetermined rules for when to step away entirely, a daily loss limit that automatically ends their trading session when hit, a weekly review that determines whether their overall approach is working before the next week begins, scheduled time completely off from any market engagement. The mental state you bring to your investment decisions determines the quality of those decisions more than any analytical framework you use. Protecting that mental state is not soft. It is a core professional discipline. Let me bring this all together. The mindset of successful crypto investors comes down to four core principles. Thinking in probabilities, not certainties. Every trade has a probability, not a guarantee. Sizing positions accordingly and expecting some losses as part of the process removes the emotional charge from individual outcomes, separating process from outcome. Judge every trade on whether you followed your rules correctly, not on whether it made money. Consistent process produces consistent results over time. Individual trade outcomes do not define you or your skill. Non-negotiable risk limits. Maximum 2% per trade. Predetermined portfolio allocation. Maximum drawdown thresholds. These limits are not flexible under any circumstances. They protect both your capital and your capacity for clear thinking under stress. Actively protecting your mental state. Defined market hours. Physical health practices. Diversification of meaning beyond trading. Predetermined rules for stepping away. Your mental clarity is your most valuable trading asset. Protect it accordingly. Here is what I want you to carry forward from this video. The crypto market will test every one of these principles. It will offer opportunities so compelling that your risk limits will feel unnecessary. It will create losses so painful that your process focus will feel insufficient. It will generate stress that makes your mental health practices feel like luxuries you cannot afford. Every time that happens, understand that the test itself is the point. The investors who hold their principles under pressure are the ones who are still here at the end of every cycle, and being still here, with capital intact and mental clarity preserved, is the ultimate competitive advantage in a market where 90% of participants eventually flame out. Master the mindset, the returns follow. If this video gave you a framework for thinking like a successful crypto investor, please hit the like button and subscribe. Drop a comment below and tell me which of these 4 principles you need to work on most. I read every comment. I will see you in the next one. Trade safe.